Welcome to the Colorado Real Estate Leaders Podcast, brought to you by Trailstone Insurance Group, bringing you interviews with Colorado's best real estate and mortgage professionals, empowering you to understand the current trends in the housing market so you can make the American dream your reality. Enjoy today's episode.
Well, it's a great day in Colorado, and welcome to the Colorado Real Estate Leaders Podcast. Today we have with us Luke Kinsey, who's a loan originator with Prime Lending. Luke, welcome to the program.
Glad to be here. Thanks, Mike.
You are welcome, and I'm looking forward to learning about how you serve your clients. But first, I like to always hear the story of what got you into the mortgage business back in the day. Was it a family member, a friend? How did you learn about getting into lending?
Yeah, so my mom's been doing lending for about 25 years out here in the Colorado market. Growing up, I never had an idea that this is what I was going to do. But when I was in school, it was my last semester, I went to a job fair, got connected with a financial planning company and with a mortgage company. That mortgage company was Pulte Mortgage. And at that time, coming straight out of school, I was like, hey, Pulte Mortgage got exactly what I'm looking for. So I went ahead and made the jump with them. And that's really where I started my career in lending.
And Pulte, wasn't that a home builder? So that was the mortgage company connected to the home builder?
Correct. Yes, sir.
Yeah. So basically, you're telling me you are in competition with your mom.
Yes.
Okay, I'm sure that makes for some fun little times. You know, what did you originate last month? So do you right now, when you now are working with your borrowers, are they typically looking to buy their first home? Or are they investors? Are they building homes for new construction with your Pulte background? What does the mix look like in who you're serving?
Yeah. So when I was with Pulte, it was a lot of just new construction. I wasn't really taking anything outside of new construction, but with my time there, it just got me insane amount of reps. I originated probably over 300 mortgages in that time. So that really just got me the knowledge that I needed, got me to be adaptable. And then I entered into the consumer space, retail, at the beginning of this year. So right now that I've made that switch, I do still have very strong construction ties. So I work with new home builders. Here at Prime Lending, we do have construction loans. So if anyone's like, hey, I want to do a private build, that's kind of my bread and butter. But with my time there, I also learned how to work really well with first-time home buyers. Myself, I'm right around that 30s age, so I connect better with that younger generation. And I really like to help guide them through the entire process. I know sometimes people will get a mortgage and they're like, oh, I just gave them the down payment. Now I have this monthly mortgage payment, but I don't know what I got myself into.
Yeah.
So when I work with first-time home buyers, I really like to hold their hands, make sure that they're educated on as much as they want to know. If they want to know the nitty gritty, how do you get down to my debt to income ratio? I can go through that. Or if they're like, hey, give me the meat and potatoes. But yes, I'd say now that I am in the retail space, I do still do construction. I work really well with first-time home buyers, and I work really well with investment or investors, I should say.
And all of them require education and care. And it's not just next, fill out this form, next. It's having to teach them the process, because even if you have bought a home or two before, typically it's many years in between. So you don't really remember the process. And, doing 300 loans in that first, period of time, you get to the point where it's like, you just know the process and you use, vernacular and, shortcuts and this and that and terms and acronyms. And you got to remember that, they don't know what DTI means, so as you know, and what you just said, helping someone understand the process and telling them the next step ahead helps them feel like they're part of the process. And I think that is very refreshing.
Yes, I would agree.
Now, also, you kind of think about a stair step, from a first-time home buyer. In a period of time, they might need to do something else, like, oh, well, we're going to buy a bigger home, or we're a young couple and we have kids, so now we need the bigger home. So maybe that means that they're going to buy a bigger home, but maybe the one they're in was a two-bedroom condo they want to keep as an investment property. Well, there could be some planning and strategy around that. Is that how to make that move? So you also might have someone that is like, hey, you know what? We've owned a couple, 3 homes. We want new construction. So I think that the question that I am wondering about is, do you lay out for your borrowers, hey, I've heard you say some things here, what your future plans are. Here's just something to consider. You get into this home and stay here a period of time, and then we could look at doing a new construction structure down the road. We can look at getting you another primary residence and retaining this as a, investment property. What are some of the kind of holistic 360-degree advice that you give to your borrowers?
Yeah. So when I talk with buyers, whether it's their first home, second home, third home, I really like to have a well-rounded conversation right up front before we even go through the process of what are your long-term goals. If they are a first-time home buyer and they're like, hey, I just plan to use this for 2 to 3 years, we'll kind of structure the loan and what makes the most sense, and is going to give them the most benefit in the long term, and then kind of start talking about, hey, once you've done this, then we could upgrade to turning this into an investment, or we could just upgrade, sell this home. So I'll really do a well-rounded plan, regardless of where they're at in the stage, just figure out exactly what's going to meet their needs and get them to their end goal. And I really like to build that relationship with buyers. So it's more so I'm a lender for life versus that one-time transaction where it's just kind of like, hey, thanks. Okay, you're out the door. So yeah, I always go through any options that the buyers want. If they want to look really long-term, if they want to just look short-term. And I really just get that off that first conversation with them and get a good grasp of where they're at and what they're looking for.
Because in reality, buying a home is a huge, enormous asset. It's also tied to a debt, which is the mortgage. And do you actually know the Latin derivative of the word mortgage?
I do not.
So mort is death and gauge is grip. So in reality, you're when you have a mortgage, you have a death grip. Well, you need to either have a death grip on a great asset that's going to grow and you're going to use a mortgage as a tool, an investment vehicle, or if you get into the bad kind of a mortgage that you are counseling your borrowers not to get into, with your good advice, boy, you don't want them to be in that negative death grip. So it's just kind of like a unique way to look at a mortgage. Is it really is a huge tool.
Oh, yeah.
So what are the kind of options that you are seeing people these days get into as far as, is it a 30-year fixed? Is it a 15-year fixed? Are some options or adjustable rate options, things like that?
Yeah. So I would say right now, just where rates are at and where the market's at, we are saying more so those 30-year plans are the better options. People that are thinking about doing 15, there's a slight advantage to it. I wouldn't say the pricing is all that great on them compared to the 30 years. So depending on their long-term goals, if they do plan to live there for, let's say, the next 10 to 15 years, I'm more so kind of helping people think, hey, maybe we do this 30-year. Once rates come down, then we'll refinance into that 15-year. So I would say on my end, I am pushing those 30 years. There are still certain people that want to do 15 years. ARMs are making a pretty strong comeback, so they are going to be much better priced. With those, you can always refinance out of them. So let's say in a year or two, rates do come down, you're on a 7-year ARM, then hey, you got that rate for the first 7 years, and before it even recuperated, you're good to go. If somebody doesn't have expectations to refinance in the next coming years and they're like, hey, I just want to get this done, just do this one time, I probably wouldn't suggest like an ARM, just because at that point, you're really gambling against the market. We all can see right now that the market's very uncertain, and it can kind of do whatever it wants, whenever it wants. So with those 7-year ARMs, it is more of a short-term goal.
Yeah, someone might say, hey, I plan to be here 3, 4, maybe 5 years. So then a 7-year ARM gives them a little bit of breathing room even past that.
Correct.
But so you were mentioning 30 versus 15. I would wonder if you were working with some strategic alliance partners like financial planners, you could say to that borrower, hey, why don't you get the 30-year loan? But I showed you the payment on a 15. Why don't you pay the 30-year loan as if it's a 15, but not pay extra on the mortgage? Just take that extra amount that you are willing to pay, that extra cash flow, and let's work with a financial planner, because 5 to 7 to 10 years down the road, that extra money you're putting into there could really grow and have a nice, head start toward retirement.
Yeah, that is definitely a smart route to go about it. I do have about 2 financial planners that I work pretty closely with. We haven't ran into that situation where we've fully went through that diagnostic, but that is definitely a good point of view there.
Yeah, I mean, I think a lot of people feel like, well, I want to pay extra on my mortgage, 30-year loan, but I'm going to pay $400 or $500 a month extra, which makes logical sense on paper. But 1 to 2 to 3 years into that loan of paying all that extra, what if you needed that money back? It's sunk in the loan and you can't get it back without doing a refinance and qualifying and fees and costs. So it's having some liquidity and a cushion in wherever it's going to be, whether it's a savings account or not. See, that's the thing that I think a lot of people hear, the pundits on the radio or TV go, hey, work on paying extra on your mortgage. But the problem is that they don't look at the in between. They look at the beginning and go, as soon as the loan is paid off, that's a great feeling. But what about 3 to 5 to 6 years down the road? If you needed that cash, it's in the property. And I think that's part of like what you do is educating people on what ifs. So first time home buyers, they need to think about, what about here we do the numbers. So taxes, insurance, and the mortgage and all of that. But what about the, homeowner association dues? What about the light bill, the power bill, all this, the bigger size, property that you're going to be living in? You got to factor all of that in, and we don't want that to constrict their budget and their lifestyle.
Right. Yeah, I could not be more in agreement with that.
So talk a little bit about one of the other options that are out there these days, which are really pretty popular, but a 2-1 buy down. How does that work, and what kind of situation would that be benefit?
Yeah, so 2-1 buy downs are a great option for anyone that's looking for a home in this market. As we're seeing, the market is not as competitive. It's not as much of a seller's market anymore. It's kind of becoming a middle ground of a buyer-seller's market. So we have a little bit more room to work with. So with 2-1 buy downs, really what's going on there is, let's say the rate is at 7% today. The first year that you're making that mortgage payment, your mortgage payment is going to be at 5%. The second year is going to go to that 6%. And then the third year, it's going to sit at that 7% and stay that way until you are to pay it off or refinance. So with the buy down, that is something that is getting covered by the sellers of the home. So if you're going and looking at a property and you're like, hey, can we get a seller credit? We can use that to our advantage, and we can do that 2-1 buy down. So you're not necessarily paying for it out of pocket. It's more so the seller's paying for it for your benefit. And really kind of what the seller would be paying is what the difference between 5-7% would be for the first year and 6-7% for the second year. And then we just pay that all up front at time of closing. So then the buyers get that nice little benefit of having that lower rate for the first year, another little bit lower rate.
Ease you into the mortgage payment. And it's not like it's gonna, the downside, you hear that and you're like, oh, well, the first year is 5, the second year is 6, and then it goes to 7.5. No, it goes to what the rate is. It's the same difference as getting the 30-year fixed. It's just, we're going to ease you in. We're going to buy it down a little bit so that the first 2 years are a little bit easier for you. So that's a really great program, but also a great way to use seller concessions.
Oh yeah. And then the nice thing is too, with those, there's no time frame on how soon or you can or cannot refinance. So let's say in 6 to 8 months, rates go back down to the 5s and you're already at that 5 for that first year. We could just refinance, and then you never even have to see that 7%, or ever see that 6%. So there's also that wiggle room too. It's not like you're just confined to, okay, one day it's going to go to 7. You still always have that option to refinance out of it, which is
that is great. So let's talk a little bit about some of the more seasoned, real estate owners that have owned several properties and they now want to get into buying rental units, things like that. Talk a little bit about your investment property loans, because that's a little bit different of a program. There's some other considerations to keep in mind.
Yeah. So right now investments have slowed down. It's really finding that right property at the right price for somebody. And then once we go through there, we'll kind of do the cash flow, like, hey, based on this area, do we think we can rent this for more than what the mortgage is? But yeah, working with investors right now, there's a lot of them out there kind of looking to capitalize on the slower market, and the rates are a little bit higher. So sometimes you are seeing them buy down the rate a little bit. With those, you aren't really seeing those 2-1 buy downs or anything. But yeah, with our investments, it's usually we have a program where we can do 10% down, which is pretty niche. Not a whole lot of companies have that, but I would say that the rates on that are pretty brutal. So I'd say right now it's about 15 to 20%. Some investors are putting 50%, kind of just whatever makes sense for their financial situation. And then we go through that full rounded, hey, is this actually going to cash flow? What is going to be the cap rate? And just getting that well formulated plan to make sure that they're making the best decision and they're not going to purchase an investment property that is then going to lose them money, or they're just going to be breaking even, and then after paying maintenance and management companies, they're not making anything. So yeah, with investors, it is pretty detailed, just really going through everything piece by piece and making sure that it makes sense for them versus just like, hey, you want to get an investment? Here you go.
So when you're looking at buying a house to rent out, does the investor have to qualify for the full mortgage on their own current income, or will your underwriters allow it to say, hey, the market rent is X, we can allow a portion of the market rent to offset the new mortgage that their proposed mortgage? Do they have any flexibility that way?
We do have flexibility with that. So usually we'll use about like a 25%, just to show like, hey, they will be getting this income, even though we don't have a lease or anything set up. So we still have to be more so on that conservative side. So we can't say, hey, even though you're going to be paying a monthly mortgage of 23 and right now rents are going for 24, we're just going to offset everything. We do kind of have those rules, but yes, we do definitely have options to say, hey, if somebody's buying investment, we can see where the market's at and we can do some work, with the underwriter to say, hey, we want to also qualify them with the income that they're going to be getting from this versus just their stated income or their W-2s or what's on their tax returns.
Yep, because that is risk to the lender, and the investor needs to realize that there could be times in the future where, maybe someone moves out and there's a gap of 2, 3, 4 months where they will have to cover the mortgage when there's no one in there. So making sure that everyone understands the process. And then let's kind of get back to, that the buyers, whether it's first time or not, talk a little bit about the pre-qualification versus pre-approval. What is the benefits of pre-approval versus pre-qual?
Yeah. So with pre-qualifications, those are really just that initial conversation, just sitting down with them, figuring out where they're at, figuring out generally what their finances look like, what they have for down payments, what their ideal monthly mortgage payments are, and just saying, hey, based on this information, this is right about the realm that we would be in, but it's not a hard fact. It's more so just a stated fact. And then as far as a pre-approval, that's kind of the next step above a pre-qualification. So pre-approval is once we actually get the pay stubs, once we get bank statements, tax returns, and we can verify that all the information that was stated was correct, as well as actually getting a credit report and seeing their credit score. So once we get all of those 4 items, that we send out the pre-approval, and it's a lot stronger. We've actually went and reviewed it. I went and looked at all the figures and said, yes, this actually is what you can officially afford, versus that first initial conversation where it's like, hey, based on what you told me, this is estimated where you would be. So yeah, it depends on where if somebody's at the very beginning stages, they're like, hey, I'm not planning to look for until next year. I'll kind of do a pre-qualification, like, well, based on what you told me, this is where we're at. I don't really want to pull your credit right now. I don't want to hit any dings there if you're not looking for a year. But if somebody's saying, hey, I want to buy in the next 3 or 4 months, that's where it's like, hey, let's go ahead, actually have you apply online. I'll get all these documents, and then we can make sure that you're set to go for when you are seriously looking at properties. Then you can actually go make offers with your realtor versus just being like, this is kind of where I'm at.
And do you get those documentation pieces like the income and assets and pay stubs? Do you get that in front of an underwriter to kind of look at and sign off on, or is it just, now that we've seen it, you're good to take the next step?
I would say it's case by case. If somebody's a pretty grade A paper, everything's clean cut, nice, orderly, then those are usually, I can make a decision on my end, like, hey, this looks good. I'm confident with this. But if somebody has self-employed income and we're not quite sure exactly where the underwriter is going to be, or if somebody just switched jobs and they were getting bonuses and they're getting bonuses now, but we're not sure if we're going to be able to use that, that's where I'd go ahead, send it into an underwriter, say, hey, let's get official eyes on this, versus just kind of what I'm seeing here. So yeah, I would say it really just depends. But yeah, people that are pretty clean cut, pretty straightforward, those ones we usually don't send into underwriting right away, until we actually go under contract.
You have a contract, yeah. Because like you said, there's some instances where you could say, I make X number of dollars, and that might be accurate, but a lot of it is overtime or bonus. every month, every quarter. Well, maybe the underwriter doesn't like that. So, that just saying how much you make would qualify for that pre-qualification. But once we look at the information, we got to fight uphill battle here. So I think that kind of is where Luke then looks at it and goes, okay, now I'm taking to this and I think that we need to get this looked at. But if it's someone that's had W-2 income for 10 plus years and it's X number of dollars and it all fits, then there's no need to, move it up the chain to an underwriter.
Correct. Yeah.
Excellent. Well, I think this is so interesting to hear how you got into the industry and your mom got you in, and she's still in there, and that's so wonderful. Luke, what's the best way that someone can learn more about prime lending and working with you and reach out and connect with you?
Yeah. So the best way is usually to text me. I've always got my phone on me. So my phone number is 720-209-9038. You're also welcome to give me a call. Or if you're more of an email person, you can always shoot me an email at Luke.Kinsey, Kinsey, at primelending.com. I would say those are the two best ways. Or you could also go to my website and then there's kind of a chat box there. But I would say, either texting or emailing is going to be the most efficient way.
Excellent. Well, thank you so much for coming on today, Luke. It was a real pleasure talking with you.
Yeah, thank you for having me.
Thank you for listening to the Colorado Real Estate Leaders Podcast, brought to you by Trailstone Insurance Group. To learn more about the topics mentioned on today's show or listen to past episodes, visit www.coloradorealestateleaders.com.